Hello, my name is Matthew Pumele, and I am a speaker in several business schools in Paris. Teaching international economy has become my profession after a field career in international commerce and M&A. Today's subject is accounting, the chapter number 1 to understand finance. Accounting is very often considered a source of anxiety to anyone learning business. True, it is not obvious at first sight. So the purpose of this tutorial is to give students an introduction to this amazing science. Internet, TV, the written press, or what remains of it, set economy in their front line. Economy is business, and business is economy. But the key concepts remain obscure, whereas they shouldn't be. The purpose of this website and this video in particular is to make things easy, in other words, understandable. The subject today is finance and within accounting. So let us explore it very briefly as an introduction. Finance is often misjudged, but it is essential to economy because we all need funds supplied by financial institutions. As households, we need cash to buy real estate. We need to have cash for consuming. We need cash for all sorts of investments in the future. As corporations, we need supply of funds for investments and supply of cash on occasional basis. The first step of accounting is understanding the balance sheet. The purpose of a balance sheet is to set up the financial situation of a company at a given moment. Let us start from the very beginning with some principles. A balance sheet is split between assets and liabilities. Assets represent where money is placed and liabilities where money comes from. Under liabilities must be added equity or the owner's money, the initial capital, and also including the result of the company's exercise. In other words, liabilities is where money comes from. Equity is the owner's money. Liabilities include debts and other money owed. All this put together is also named liabilities. Assets is where the money goes, split between fixed assets, that includes production means, estate, etc. Current assets, that includes cash available, inventory, disposable. Let us now exercise and take the example of a lady, Jenny DG, willing to sell dressing gowns that she buys in India. She creates her company with an initial capital of 10,000 euros, buy worth 10,000 euros of dressing gowns in India, take debts and dents for euros 10,000, buys computers for euros 1,500, and so far no sales are generated. Now, what will her balance sheet look like? Her equity is her initial investment of 10,000 euros. Her liability, the bank debts for 10,000 euros. Total liabilities will be 10,000 plus 10,000, 20,000. Now looking at assets. The only fixed assets she has are the computers that she bought. Total fixed assets will be 1,500. If you now look at current assets, her stock is constituted of the 9,000 euros worth of dressing gowns she bought. Looking at cash, she has 20,000 of initial cash, minus 9,000 in dressing gown, 1,500 in computers, final cash 9,500. Total current assets 18,500 and total assets 20,000, equaling the liabilities. So where do we see finance in this balance sheet? Let's look at two aspects of things. The idea of initial fund. The funds constitute the base of capital. Corporation's capital is the value that attracts investment. The debt. Financial institution provide money to help the companies develop. So finance is all summed up in a balance sheet.
Now you have more than a rough idea of finance as being explained by the balance sheet. If you are interested in learning further, please refer to my tutorial, which is a more detailed introduction to accounting using explanations and examples of detailed balance sheets and account statement, along with corrected exercise. Thank you for your attention.